GPIQ and GPIX, the new ETF kings. Is this the gold standard that we're working for? And this is going to be good for retirement accounts? Welcome back to today's channel. I'm Doug the Retirement Guy, and we have a lot of different questions. The Goldman Sachs QPIQ and the QPIX funds, we've been putting them under a little bit of a evaluation because they just seem to be continuously winning in a new generation of operating covered call strategies. So we wanted to look at this and say, hey, is this going to be good for a retirement account or not? Let's get into today's video. Now, before we go any deeper, I got to just give you guys a pre-warning that this video is really for educational. I am not a financial advisor, so past performances don't guarantee any future results, and this is for educational. If you need financial assistance, always contact a financial advisor or professional. So yield traps. So many funds get into this. Traditional income funds often sacrifice capital growth for high yields, and leading to what we call yield traps. Well, Goldman Sachs, with their GPIQ and GPIX, solved this by engineering for solvency and growth first. So we put down here is kind of just a hypothetical. If you put $1 million investment into GPIQ, and this is going to give you basically, you're close to about an income of around $200,000 from that $1 million. Okay, you're going to have growth appreciation, and you're going to get a total value return of over $1.2 million that portfolio value would be. So what it is they're trying to build a way of building growth with income tied together. So when we take a look at the funds, let's just break them down, pop up underneath the hood a little bit, and see what these funds actually are built for. The Goldman Sachs NASDAQ 100 Premium Income, which is GPIQ. This is mostly invests in large cap equities. The fund is actively managed and primarily involves stocks within the NASDAQ 100, combining equity investments with a call strategy. The fund seeks to generate stable income while offering potential for the capital upgrowth. So it's already sitting at $2.97 billion in assets. This fund came out. It's nothing new. This is nothing brand new, but I think their change in the way they're doing their formulas and the weighting they're doing their strategies has made some changes. The fund came out in 2023 of October 24th of 2023. 57 million shares outstanding. Distributions were $5.25 over the past 12 months for a 10.26% income dividend yield. Now, I do have to say these numbers can always change at any particular time, so we're just taking a snapshot of when we're doing this video. Now, they do pay out monthly, but here's what's going on. Look at the total return, 14.55%. That's over the past 1 year. Since inception, so we're going to be a little over 2 years old already. Since inception, its average has been 25.44%. So what's happening with Goldman Sachs is they have a different strategy going on. Well, they take that same strategy and they put it into the S&P 500. Okay, so this one, instead of using the NASDAQ 100, is using companies involved in the S&P 500. $3 billion in assets. Still, that expense ratio is only 0.29, so majority of your money is going to work for you versus expenses. 57 million shares. $4.27 in distributions for an 8.17 distribution yield. Now, this one came out same time, October 24th of 2023. So we take a look at the growth, about 4.43% growth with an 8.17% income with a total return about 13.89%. So realistically, we're probably just a hair, 0.75 percentage points difference between NASDAQ and 100. That primarily comes into what? Technology. There's a lot more technology stocks in the NASDAQ than there is in the S&P 500. We look at long term. Since inception, 23.26% average. 1 year, 13.89%, and it's positive in the 1 month and year to date. So very identical funds, very close to each other, using two different underlying assets of the S&P 500 and the NASDAQ, but getting similar results. So why is this? What have they done differently? Well, we call this Generation 3. It's the optimized standard. When QYLD came out, they had, we call it Generation 1. They did it with the synthetics. They did it with different ways of generating that income. And then JPI came out, and we said that was the defensive. The Gen 2 is more defensive side of it. Well, with Gen 3, with like showing here in GPIQ, their dynamic design is just surpassing everybody out there. And it's a definite Gen 3 standard represents a shift from the rigid retail products to sophisticated institutional grade financial engineering. So is it that we can't do it? No. What they've done is they've used qualitative strategies wrapped inside an ETF. They have direct ownership of the Mag 7 and the index stocks. And they have a dynamic engine, intelligent coverage that adapts to the VIX. So what it's doing is when we have volatility, it's capturing volatility. When we get the VIX on the upside or downside, it's covering those. It's able to make changes quicker, faster, and has a deeper involvement into the stocks that are generating the income, like Mag 7s. That's your tech stocks going on. When we put the comparisons up with Goldman Sachs GPIQ up against QYLD, just to show you the difference in those strategies that are operating, look at the hardcore numbers. Now, QYLD's been out there for a longer period of time. We understand that. But they've never broke the 10% total return program. Since inception, 8.21. 10 years, 9.82. 5 years, 6.67. 1 year, 6.25. We're not saying that QYLD is a bad fund from Global X. What we're saying is there's another way of doing it that can generate more income and more growth. So take a look at the numbers on the side. Your growth of GPIQ is 2.02%. Income 10.10%. For a total return right around 16.05%. Now, the growth side of it, like I said, these numbers change on a fairly regular basis. So when we get into this regular basis strategy, doing this video, your numbers are going to be a hair off, but the total return, which is why we focus on it, total return over the past 12 months will be identical. Same thing with QYLD. They have a loss of 4% in growth, 11% in income for a 6.25% total return over the same exact period. So that's 10% more that you're going to get out of GPIQ than having QYLD in your portfolio. When we take a look at now putting up in JP Morgan's equity, JPI, now this one does a little bit better performance. Again, 12% since inception, 10% over 5 years, 8.9% over the past year. The growth has been there at 0.29. 8.02% in income for an 8.99% total return. Comparing that to GPQ, again, it is giving you almost double the amount of total return. So these are the positive things that you got to look at with the GPIQ and the GPIX. So here's more of detail what we're actually doing. The dynamic engine. 25 to 75% overwrite. Managed by Goldman Sachs, their investment strategy, QIS, their team uses a dynamic engine that makes static funds obsolete by adapting to a covered call market volatility. So like in a bull one, when the VIX is low, the coverage drops to 25%, while 75% of the portfolio is run uncapped to capture the rallies. So it avoids what they call away risk. Okay, So what they're trying to do is we're going to go after growth when we're in bull markets. In bear cases, so when the VIX gets high, the covered call will ramps to 75%, maximizing the income buffers, selling expensive premiums, enhancing the downside cushion. So this whole flex option, which is a European style investments, the fund eliminates the early assignment risk and optimizes tax efficiency under 1256 contracts, adapting so the investor doesn't have to. This is where I always call it, if you're going to have a managed account, if you're going to have a managed ETF, they should be doing their job, and they're doing it with such a low operating fee. So this is how they're operating, where I told you that QIS, that investment strategy they use, is in bull markets, they're trying to capture as much growth as they can. In bear markets, they're trying to make as much income as they can. And it's a happy mix between the two. So solving the NAV erosion trap. The legacy funds, they failed the path of dependency. They called away during rebounds and never recovered their high water marks. So 100% static covered cap upside. When you cap your upside on a fund and the rally begins, it's going to take a long, long period. So you're going to have a very, very long bull market to rebuild and recapture your upside and get back to what we call your high water marks, to where you were. So this could lead to NAV erosion and definitely the yield trap dynamics that we talk about. Now the Gen 3 situation, where they're doing the dynamic 25 to 75% coverage of uncapped participation, helps along with that. It helps prevent the NAV erosion. I won't say it won't happen, but it helps prevent that. And it gives it a upside to what the other strategy funds are. Also, by dropping the coverage to 25% through low volatility, this one helps recover and capture the recovery part of it that the regular funds miss out on. So since April 2025, I call it the stress test. When this thing dropped off in April 2nd, you compare this to a lot of different funds. And what you see is you see the drop off, and then you see the recovery way above where it was prior to the drop off. And then you take a look at the dividends. Their dividends did not drop that dramatically much. You're looking at maybe a 5-cent per month payoff difference. And then since you got the growth and then the recovery of the dividends, you've achieved that money back over that short period of time. So despite the market dip, GPIQ posted a 5.86 total return in quarter number 2 of 2025. The recovery mechanism, the share price rebounded from a low $44 up to $53 by early September 26, confirming that the dividends were not devastated by the return of capital. The verdict: the fund blends but doesn't break. Successful recovery in the value while providing untapped income for investors. So the constructive versus deconstructive ROC and the power of the tax deferred. Now, I will always say this right at this point. Always talk to a financial expert. Always talk to a tax expert when we get into these. But I'm going to give you the highlights that I understand that I go from here. The destructive ROC, bad funds return principal without profit, lowering your cost basis and the asset value simultaneously. Okay, this is when ROC does not work, and this is when ROC is bad for a fund. It's not just taxes, where it's a return of capital to keep the dividends paying out. The constructive ROC, GPIQ, generates profit but uses tax loss harvesting to categorize payouts as ROC. Big difference between these two. You have to understand, is a fund making enough money to pay out like GPIQ does, or as a fund not making enough money and paying out your money back to you as ROC. It's legal both ways. This tax hack paid 0% taxes on dividends today by reimbursing the full amount to maximize the compounding power. And the IRS loan, it's deferring taxes indefinitely, keeping more of what you earn working for you in the marketplace. So GPIQs, the Goldman Sachs program, uses that constructive ROC structure that allows 100% reinvestment. It's just a unique way that they use their tax efficiency on this. Now, I know a lot of people will say, well, that's great. Those funds are old and outdated, but what about the new QQQI? Well, I put this up against it as well because I've been looking at this. Look at, first off, the management fees. When we're talking 29 cents up to 69 cents for the NEOS program, there's a huge difference between there. But GPIQ's dynamic 25 to 75% overwrite and QQQI's static call spread kind of leans, again, explaining both systems. I said that GPIQ is definitely a smarter strategy to use. Tax efficiency, well, we explained it quickly, and I know not in enough depth, but we're using the ROC with GPIQ. So you're paying 0% today. They're still using those 1256 contracts as well, while QQQI uses that 60-40 split. It's more efficiency using the constructive ROC. Management fees we just talked about, and the NAV preservation. It's a proven program that they will continue to prove on their NAV by using that splitting of that strategy. So just to show on top of that, when we look at the numbers, both funds fairly new to each other. The growth side of it, we continued having growth with Goldman Sachs. We had an income of 10.10% for a total return of 16.05%. While NEOS comes back, had a loss of 0.45%, but an income of 14.05 for a total return of 14.85. Even with QQI being known as one of the best funds out there in retirement accounts, GPIQ actually is beating it at its own game. You take a look at inceptions, 26% for GPIQ, 18.63 for QQQI. 14.85% over 1 year, 16.05% over 1 year. So again, I'm not saying QQQI is a bad fund. I'm just saying Goldman Sachs has a unique way that fits and creates better total packages inside a retirement account. So when we talk about risk, the raging bull risk, the vertical rallies, NASDAQ gets up 40%, even a 25% overwriting drags. So it will lag the QQQ, okay? It's not going to follow the underlying asset to a whole, but QQQ is not built for income. It's built for growth. The manager's risk. It relies on the QIS teams correctly assessing the volatility. Incorrectly, high coverage during a market could lose to an upside. And the concentrated risk, GPIO is 51% tech. While the income cushions the blow, it doesn't prevent losses of those Mag 7 sector wrecks. So, honestly, there is always risk in what we do. There's always risk in what we operate with. But across the board, more of the problems that we're going to run into is managing your NAV and managing your growth and managing your risk. And that's what I wanted to show you today of how the Goldman Sachs funds are actually doing it properly. So my final verdict of this is I call it the gold standard, because the gold standard checklist is a Pentagon style design. Zero erosion of your NAVs. Dynamic engine, low cost, works in the tax efficient way, and it's industrial grade investments. Long-term investments. Ideal core allocation for those seeking consistent income while growing their principal. The income seekers, overweight with holdings to replace legacy yield traps. They're targeting at 8 to 11% sustainable yields. The tax accounts, they prioritize the GPIQ and the GPIX for tax hacks. That constructive ROC to defer tax liabilities. And basically, as I call it, the legacy holders. Rotate immediately out of Gen 1 funds like the QYLD to stop the NAV erosion. It's just a new frontier. It's a new way of doing these funds. And I think Goldman Sachs has the golden standard of making things properly and right. So I have to ask you, what do you guys think of these funds? They've been out. They don't get a lot of press, but I think they're the funds that a lot of retirees probably need as an additional asset in their funds, especially in today's market. Let me know your comments below. Leave a comment. Don't be afraid to hit that like button and just tell me what you think of these funds. I'd love to hear from you.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments